Bonds are back, so 2023 starting yields are the highest in years. The bulk of the Fed tightening cycle is over, and prices typically fall when interest rates rise. Inflation has continued to decline, and bond market yields are attractive relative to any other investment income. Okay. So what we're looking at here is average yield in comparison from 2021 to 2022, and looking at the duration on various bonds. So as we look at high-yield corporate bonds, at the end of 21, the yield was 4.2% with a duration of about 3.9 years. Today, that same bond yields 8.4%. If you look at investment-grade corporate bonds, the yield was right around 2.3%, and that yield today is 5.1%. Even Treasury bonds, which are yielding 1.2%, are now yielding on average 3.9%. And as we compare that to dividends, you can see dividends have only grown from 2.5% to 2.6%. So earnings recession. So corporate earnings estimates remain relatively high. We're expected some form of earnings recession because of higher costs, which again results into lower margins, higher interest rates, and lower consumer spending. Earning downgrades outnumbered upgrades in 2022, and this is actually the third step in the HOPE framework. Housing, orders, and now profits is the third step. So we do expect earnings to either be slightly negative or again, maybe flat. So this chart shows you that downgrades prevailed throughout 2022. And you can see that in the beginning of the year, we actually expected earnings to be better than we did toward the end of the year, where there was a lot more downgrades to companies' earnings, especially in certain sectors like consumer cyclicals and technology stocks. Jobs. Unemployment is likely to rise in 2023. The Fed forecasts unemployment could rise this year to 4.6% from its current rate of 3.5%. Earnings reports will also be watched for further evidence of layoffs. The most pronounced layoffs we've seen so far are in tech. Amazon, Salesforce, Alphabet, Microsoft, Meta, Netflix are just some of the companies that have started layoffs. And again, this is the last step in the HOPE framework. Housing, orders, profits, employment. So this chart is showing the unemployment rate going back to 2000. The gray bars are recessions. And you can see from 2001 to 2002, we saw a slight increase in unemployment. And the same thing occurred from 2008 to 2009 during the Great Recession. The anomaly that happened during COVID, we can throw that out. But as we look at now into 2023, we would expect, if we see a recession, to see an increase in unemployment. Specifically, as we said, probably up about 1% from where we're starting at today. So as I mentioned previously, the HOPE framework. And you can see from this chart, this is how particularly every rate cycle goes, starting with housing. And we saw that slow down about March of last year. Orders started to slow about, again, the same time. Profits, we saw those as we reflected back. They started about July or about August of last year. And now employment. We haven't seen this yet, but that's the expectation to complete the rate cycle. And that eventually we would see a Fed that would be more accommodative and less actually restrictive when it comes to monetary policy. And that's probably going to be throughout 2023 into early 2024. Thank you again for joining us for 3 and 3.